Welcome back to the Deep Dive. Great to have you with us again. Today, we're circling back to KIP REIT. We looked at them last quarter, remember?
We did. Q3 FY 2025 was pretty strong on the surface. Revenue growth was impressive, over 60% year-on-year, hitting nearly RM 40 million.
And their net property income, the NPI, also had a good jump, up over 50%.
Yeah, that was mainly driven by their core KIPMalls doing better, plus those newer acquisitions starting to really contribute deep polls, TF value, and that CR35 industrial asset.
Right. The DPU for Q3 itself was flat, but the year-to-date figure was trending up, which was, a positive sign.
And we also flagged that industrial segment creeping up, reaching about 5.2% of revenue in Q3. Still small, but growing.
Exactly. Small but growing. So building on that, today's mission is to really unpack KIP REIT's latest numbers, Q4 FY 2025. We want to get into the hood, understand the strategic moves, the challenges.
And trying to answer that key question. Can their aggressive growth, especially through acquisitions, keep outpacing these rising costs we're seeing? That seems to be the core tension right now.
Definitely. We'll be looking for clues in the latest report. But first, just a quick reminder of what KIP REIT actually is.
Sure. They're a Malaysian REIT, primarily focused on retail. Their niche is operating these neighborhood malls, often in what you might call secondary locations. Think Tampoi, Kota Tinggi.
Yeah, their strategy is all about that essential service tenant mix. Groceries, pharmacies, local shops, catering to suburban communities.
It's like you said before, they're kind of the neighborhood grocery store of REITs. Not glamorous, but aims for resilience.
Exactly. As of this latest quarter, Q4 FY 2025, they've got 10 retail malls and 4 industrial properties.
And despite the industrial growth, retail is still the giant, bringing in just under 95% of the revenue. Industrial is sitting at about 5.1%.
Okay, let's dive into the Q4 spotlight then. Gross revenue and NPI. How did they look compared to last year?
All right, so Q4 FY 2025 versus Q4 FY 2024. Gross revenue came in at RM 39.89 million. That's a pretty solid increase, 22.2%, up from RM 32.639 million the previous year.
Okay, 22%, that's strong top-line growth.
Yeah.
What about NPI?
NPI also grew, hitting RM 28.051 million. But notice this, that's only a 6.1% increase from RM 26.429 million in Q4 last year.
Okay. So revenue up 22%, NPI up only 6%. That gap is definitely something we need to explore.
Absolutely. The drivers for the growth are similar to Q3, the core KIPMalls performing well, plus the contributions from deep polls, TF value, and the CR35 industrial asset. But that gap between revenue and NPI growth, that points towards costs.
We'll get to costs in a moment. First, how did Q4 look compared sequentially to Q3? Any slowdown or acceleration?
Sequentially, Q4 versus Q3 FY 2025, it was much more modest. Gross revenue nudged up just 0.9% from RM 39.537 million to RM 39.89 million. So steady, but not the big jumps we saw year on year.
Right, consolidation almost. And the full picture for the entire financial year, FY 2025 versus FY 2024.
For the full year, the growth looks robust again. Gross revenue hit RM 136.133 million. That's up a significant 33.3% from FY 2024.
Wow, okay.
And NPI for the full year reached RM 96.823 million, which is a 24.4% increase from the previous year. So big picture, the annual growth is definitely there.
Okay, let's talk distributions. The DPU, that's what a lot of REIT investors focus on. How did that look for Q4?
For Q4 FY 2025, they proposed a final distribution of RM 16.1 million. That works out to 2.018 sen per unit.
And how does that compare year on year?
It's a slight increase, up 2.7% from the 1.9650 sen they distributed in Q4 of FY 2024. The actual distributable income for this quarter was RM 15.694 million.
And the full year DPU, did that hold up despite maybe some pressures?
The full year DPU for FY 2025 landed at 6.8 thousand sen. That's a 2.0% increase from 6.6650 sen in FY 2024. So yes, the annual DPU did inch upwards.
Yeah, there's a tax aspect here too, isn't it?
Yes, and this is quite important for unit holders. About 1.999 sen per unit of that Q4 distribution is non-taxable. This benefit comes from things like capital allowances and tax-exempt income.
Right, because they distribute at least 90% of their income.
Exactly. That policy helps them maintain tax exemption at the trust level and passes some benefits to unit holders.
Okay, so the top line looks decent, DPU is growing slightly, but let's circle back to that gap between revenue and NPI growth. This points to margin pressures, the rising cost story.
This is really the crucial part of a Q4 story, I think. That difference, revenue up 22%, NPI up only 6% year on year, tells you costs are rising significantly faster than income.
Where are the biggest jumps?
Utilities. They absolutely soared, up 119.4% year-on-year in Q4. Went from about RM 2.9 million to over RM 6.3 million.
Wow, more than doubled. That's a
Yeah.
huge hit. Is that just energy prices or something specific to KIP?
It's likely a combination, but that magnitude is really striking. It suggests maybe higher tariffs hitting them hard or perhaps increased consumption in the newly acquired larger properties. But whatever the reason, it's a massive increase.
And that feeds into the broader operating expenses.
Yes. Property operating expenses overall jumped 90.6% year-on-year in Q4. That's RM 11.8 million compared to RM 6.2 million last year. So think maintenance, cleaning, security on top of utilities.
So more money coming in the door from revenue, but a much larger chunk is going straight back out on running the properties.
Precisely. And it's not just property costs. Borrowing costs were also up by RM 2.7 million in Q4 compared to last year, which is expected given the debt they took on for acquisitions.
And even the manager's fee went up sharply.
It did. A huge jump, actually. 408.8% year-on-year for Q4 from about RM 800K to over RM 4 million.
Why such a massive percentage increase?
Two main reasons given. First, there was a change in the fee rate structure that took effect from FY 2025. Second, the fee is linked to performance and asset value, both of which increased. So higher AUM and NPI mean higher fees.
Okay, so costs rising across the board, operations, debt, management. Given these pressures, how does their balance sheet look? Is it strong enough to handle this?
Let's look at the numbers. Total assets reached almost RM 1.6 billion. RM 1,577 million as of June 30, 2025. That's up quite a bit from RM 1,136 million a year ago, reflecting the acquisitions.
And their gearing, debt levels.
The gearing ratio was 39.49%. Interestingly, that's actually down slightly from 41.1% in Q3. Still, it's elevated compared to historical levels due to the debt taken on for growth. It's below the regulatory limit, but something to watch.
Do they have cash on hand?
Yes, they reported RM 57.081 million in cash and bank balances, which provides some operational cushion.
Now, net asset value NAV per unit. What's the story there?
The NAV per unit, after accounting for the distribution, stands at RM 1.1196.
Okay, RM 1.1196. But the market price is around RM 0.835.
Yeah, exactly. And here's where it gets really interesting, as you said earlier. That's a significant discount to NAV. You're looking at, what, about a 25% discount?
Yeah, roughly. So the market is valuing it considerably lower than its reported book value. Why the gap?
Well, that leads us to perhaps the biggest surprise in this quarter's report, the unrealized gains.
Ah, yes, the fair value adjustments on their properties. Tell us about that.
It's massive. They recorded RM 63.27 million in unrealized fair value gains on their investment properties just in Q4.
63 million. Compared to what last year?
Compared to just RM 2.85 million in Q4 of FY 2024. It's a huge jump.
Where did that gain come from?
It's spread across 14 properties. It includes the newly acquired ones like Deepholz, TF Value, the Cheras Jaya Industrial Asset, but also appreciation in their more mature KIPMalls like Kotawa Rizal, Masai, and Tampoi. Independent valuers basically marked up the value of their portfolio significantly.
So while it's a paper gain, it's a strong signal about the perceived value of their assets.
Absolutely. I mean, think about it. That RM 63 million paper gain is more than 4 times their realized profit for the quarter, which is about RM 15.2 million.
That's incredible.
It strengthens their balance sheet, improves that NAV figure we just talked about, and could potentially make future borrowing easier or cheaper. It definitely adds a fascinating layer to that NAV discount discussion.
It really does. Okay, let's shift gears to their strategy. What's happening with their acquisition pipeline? They've been quite active.
They have. On the industrial side, the Cheras acquisition was completed back in February 2025, so that's done.
Good.
However, there are delays with 2 others. The deals for the Port Klang and Johor industrial properties have had their conditional periods extended again, now until August 28th, 2025.
Extensions usually mean some kind of hurdle or complication.
It often does. Property deals can be complex, so progress, but not everything is smooth sailing on the industrial front.
What about retail acquisitions? Are they still adding malls?
Yes, big news there just recently. On July 22nd, they got approval to acquire 4 new retail properties for a total of RM 118 million.
4 more. Which ones?
The main one is KIPMalls Desa Coalfields for RM 62 million. Then there's a Lotus's store in Indera Makota, Kuantan for RM 39 million, and 2 smaller retail properties also in Kuantan.
So a clear, continued push into retail alongside the industrial diversification. How are they funding these new retail buys? That's RM 118 million.
The plan is to partly fund them through a private placement. They're looking to issue up to 160 million new units.
Okay, so bringing in new equity capital, likely from institutional investors. That avoids piling on too much more debt, but
it means dilution for existing unit holders. Each existing unit will represent a slightly smaller piece of the pie. It's the classic REIT trade-off. Fund growth with equity or debt.
makes sense. What's the official management outlook? Are they bullish despite the cost pressures?
They project confidence. Quoting directly from the report, the manager holds a favorable outlook, citing the positive performance of the existing portfolio and their strategic endeavors to actively enhance leasing and operational strategies while pursuing investments of high quality.
They expect.
They anticipate the ability to sustain a stable performance throughout fiscal year 2025. So, cautiously optimistic, aiming for stability while executing growth.
And this ties back to their longer-term ambition, right? They have a big target.
They do. We mentioned this last time. Their stated goal is to scale their assets under management, AUM, up to RM2 billion within the next 3 years. That's a very ambitious target and signals a continued aggressive growth strategy.
Okay, ambition is good, but growth has risks. Let's nail down the top 3 risks facing KIP REIT right now.
First, those acquisition delays we mentioned. The extensions for Port Klang and Johor industrial properties highlight execution risk. If deals keep getting delayed or fall through, it impacts their growth timeline and expected income streams.
Risk number 2 has to be interest rates, right?
Absolutely. Interest rate exposure is key. As we noted, 61% of their debt is on floating rates. Their weighted average interest rate was 4.62% as of June 30th. If rates go up further, that hits their bottom line directly through higher borrowing costs.
And the third big risk is the one staring us in the face from the Q4 numbers.
Operating cost inflation, it's unavoidable. Those huge jumps in utilities, plus 119%, and maintenance housekeeping, plus 83%, are feeding into that overall 90% increase in property operating expenses year on year for Q4. If they can't get a handle on these costs, it will continue to erode profitability.
And you flagged an interesting geographic point earlier, too, something about the northern region.
Yeah, this was a bit of a surprise buried in the segmental data. While overall revenue grew, their northern region revenue actually declined by 48.3% year on year in Q4.
Wow, nearly halved. That's starkly different from the overall picture. Any explanation?
The report doesn't explicitly state why. It could be due to a specific mall struggling, maybe higher vacancy in that region, or potentially even a divestment we aren't aware of. But it's a significant outlier and worth watching.
Definitely a curious point. Okay, let's try to assess their competitive strength using our Moat scorecard.
Yeah.
How durable are their advantages? First up, tenant stability.
I'd give them a 4 out of 5 here. Their focus on essential service tenants provides a solid base. Plus, that high reported occupancy of 97.8% in Q4, with no major vacancies mentioned, suggests tenants are sticking around. Seems like a pretty stable base.
Okay, 45 for tenants. Location advantage. They're in secondary markets.
Yeah, I'd score this a 3 out of 5. Operating in underserved neighborhood locations gives them a local captive audience, which is a strength for their model, but these secondary markets might offer less rental growth potential or diversity compared to prime city locations. It's a specific niche advantage, not a broad one.
Makes sense. Cost efficiency. This seems like the weak spot right now.
It really does. I have to give them a 2 out of 5 here, mainly due to those surging operating expenses we keep coming back to. The 90% plus jump in property OPEX in Q4 is a major red flag regarding their ability to manage costs effectively in the current environment.
Okay, a 2. Finally, scalability. Their ability to grow.
This looks strong. A 4 out of 5. They have a very active acquisition pipeline across both retail and industrial. Plus, that clear, ambitious target of hitting RM2 billion AUM shows a strong intent and strategy for scaling up significantly.
All right, so summing up the Moat. Strong on tenants and scalability, okay on location, but currently weak on cost efficiency. Let's translate this into the investment thesis. What's the bull case for KIP REIT?
The bull case rests on 3 main pillars, I think. First, that distribution yield is attractive, currently around 9.67% based on the annualized DPU and market price. That's a solid income return for investors.
Second,
the significant NAV discount. Buying at RM 0.835 when the NAV is RM 1.1196 suggests potential capital appreciation if the market re-rates the stock, perhaps spurred by those large fair value gains.
and third, the growth itself.
Exactly. The potential for continued acquisition-led growth is clear. They have a pipeline, a funding strategy, and a target. Bulls are betting they can execute this expansion successfully.
Okay, that's the bull view. Now, the bear case. What are the main arguments against investing?
The primary bear argument is that those rising operating expenses are seriously eroding NPI growth. Again, that GAAP revenue up 22%, NPI only up 6% in Q4 YoY is critical. It shows profitability isn't keeping pace with the top-line expansion.
What else?
The second point is the financing of that growth. Increasing debt levels, even if gearing dipped slightly this quarter, still add risk. And the planned 160 million unit private placement will dilute existing unit holders, potentially capping per unit growth metrics even if the overall portfolio grows.
So dilution risk and the impact of rising costs on actual profit growth.
Those are the key bear concerns, yes.
So wrapping this all up, what does it mean for you, our listener? KIP REIT delivered strong headline growth in Q4 FY2025, no doubt. Revenue and NPI were up, driven by their existing malls and the new acquisitions coming online.
And those massive fair value gains were a real highlight, boosting the NAV significantly. They're clearly executing an aggressive expansion plan, aiming for that RM2 billion AUM target, and they remain committed to paying out a high distribution, helped by that tax advantage.
But, and it's a big but, this growth is coming alongside sharply rising operating costs, particularly utilities, which are squeezing margins hard. Plus, they're taking on more debt and planning equity dilution to fund the expansion.
It really crystallizes the central question for potential investors.
Which leads us to our final thought for you today. How does KIP REIT's aggressive expansion strategy, this push for growth funded by both debt and new equity, actually align with your personal investment goals and, crucially, your comfort level with risk in the current economic climate?
Yeah, it's a trade-off, isn't it? Potential growth versus rising costs and financial risks. Something for you to really weigh up. Can they successfully integrate these new assets and get costs under control? That's the key thing to watch going forward.
Great points to ponder. Thanks again for joining us for this deep dive into KIP REIT's Q4 performance. We hope you found it valuable.
Yes, thanks for tuning in.
We'll catch you on the next deep dive. Stay curious, everyone.